In this week's AMT Insight, I'm going to talk about the lead market's recent price performance. Now, over the last year, lead has generally underperformed base metals and other commodity assets, and that's largely been due to its weak fundamental narrative, although it's still up because of the overall bull market that we've seen across the commodity space. In April, all LME-based metals rose quite strongly, and that was largely driven by dollar weakness and rising economic sentiment and confidence more generally across commodities in the demand and accelerating prices. Lead performed quite well because of its relative cheapness, so people are buying into the complex and looking for value. Now, in terms of what was driving that specifically for lead, the algorithmic funds played a really crucial role, really. So you've really seen that over the last few weeks, last month, that speculative positioning by funds in terms of long positions has really increased quite substantially, back to the kind of levels we were seeing earlier this year. In terms of physical participation, that was pretty limited in the main rally, although in terms of last week, we've seen the nearby spreads on the LME going into backwardation, so perhaps physical participation and interest picking up a little bit there as well. In terms of the Chinese market, SHFE prices have generally struggled to keep pace with the gains of the LME over the last few weeks, and that's really being driven by weaker domestic market fundamentals. So battery end use in China is really quite disappointed since Chinese New Year. Battery distributors and manufacturers are holding too much stock. The end use isn't really there, and so they're dialing back on their production and their operating rates and their demand, and that's feeding through towards lead. And you see that in the SHFE inventories, which have continued to spike to kind of higher levels. In terms of smelter output, that's the other factor really driving the rise in inventories. That's been quite strong both across primary and secondary producers. And you see that big, quite strong increase in output reflected in tighter concentrate treatment charges, and also a tightening of the scrap market over there at the moment too. If we see how that's really reflected the SHFE LME price differential, you can see that the SHFE is now trading at quite a significant discount to the LME on a kind of paper basis. And that's getting to the point now where it's starting to generate some potential export arbitrage opportunities, perhaps, for exporters in China. In terms of outside China, we've seen really physical markets for lead performing quite strongly. So you've seen quite strong replacement battery demand across Europe, across the US, and you've seen that reflected particularly in the US, where the domestic inventory isn't really there, where the high cost of shipping and disruption to shipping is really causing some issues and pushing that US premium higher. I think contributing to that was a closure of the Clarios recycler in the US in March. And you've also seen shipments of metal rumoured from Europe to perhaps come in to relieve that tightness, but that's something that we're yet to see just yet. In terms of the car chip, computer chip shortage and the impact in terms of disruption on car manufacturing, that's something that could perhaps have an impact on demand for batteries into the second half of this year. I think for now, actually, it's been quite positive because it's driven demand for used cars amongst your average consumer, and that's been quite a key factor in keeping replacement battery demand quite strong. And that's alongside the overall kind of restocking in the replacement battery space that we've seen as well. But that's something potentially that could start to dial away into the summer, could start to taper off over the slower seasonal summer months. Now, the other big key factor for lead, I think, why it's been lagging the rest of the base metals complex has been the long-term demand narrative. So in terms of the green transition and green energy optimism for demand that you've seen in copper and nickel, lead's never really had that same optimism or that same narrative behind it. So the transition to EVs is obviously creating a substitution threat in terms of lithium-ion batteries for lead-acid batteries. You've also had this long-running desire amongst regulators to phase out the use of lead in applications where it's possible and substitution is available because of its toxicity as a metal. However, this transition away from lead-acid batteries is going to take time. The aftermarket in terms of combustion vehicles is going to go well on over the next decade. It's going to be sustained. It's not going to be a really rapid shift away from lead. And also there's other issues there around, recycling supply chains for lithium-ion batteries and the supply of some of these alternative battery metals in terms of where they're coming from, and issues in sourcing the right amount of material that's going to be required for this kind of transition. So overall, I'd say for lead, we are still in a bull market, so it's hard to kind of discount a continuing uptrend for as long as current macroeconomic drivers remain fairly positive. But I think that lead is going to continue to be a reluctant follower of this trend in terms of following what the other base metals are doing. And I think continued underperformance of those other base metals is probably likely, again, because of that weaker longer-term fundamental narrative, and indeed shorter fundamental narrative in terms of expected surpluses this year that we're seeing for lead. So in terms of the rest of Q2, based on kind of a technical analysis of the uptrending channel for lead, we can maybe expect prices to continue ranging between $2,000 to $2,300 over the rest of the second quarter. Thanks for listening to that insight on lead. If you are interested in the weekly insights that we're putting out, strongly encourage you to follow us, Amalgamated Metal Trading, on LinkedIn, and also now on Twitter, and to visit our website to see the other insights that we've been producing. Thank you.